always say beware the hype. When a beloved brand comes public with a bang and then its stock keeps soaring, you need to exercise some restraint because sometimes these deals are too hot to handle, even ones I love. Take Dutch Bro, the Oregon-based coffee chain that had its public debut a month ago. Now, I love Dutch Bro. I used to go there all the time when my daughter lived in Ashland, Oregon. I'm telling you, addicted to the stuff. The coffee is incredible. They got these really cool parking lot kiosks. And the Annihilator, that may be the hottest octane drink I have ever had. And I crave octane in my coffee. But after another 4% rally today, the stock is scalding hot. I don't know what to do. I don't want you to get burned. I want you in the stock so bad, but I'm afraid I'm going to hurt you. See, Dutch Bro came public at $23 last month, well above the proposed price range. Then it opened at $32.50, giving anyone who got in on the deal a huge gain. But then within days, it had spiked to the mid-50s, just kept going and going. Although it pulled back to $41 last week when the market was rolling over, it's rebounded like crazy over the last 2 days, trading back up to 53. Why the recovery? Because the quiet period for analyst coverage ended, and a host of bullish analysts just rushed to initiate coverage. I get that. By my count, Dutch Bro now has 8 buy ratings and only 1 hold. And it's kind of a cult thing. I remember saying to my daughter, let's go to a Dutch Brothers. And she's like, Dad, it's Dutch Bro. Everybody knows it's Dutch Bro. Who knows it was Dutch Bro? What's it look like to you? Anyway, initially I was cautious on the stock. No, after, when it opened 32, I said, wow, that's... But I worried that it'd come up too far too fast. But after seeing these bullish initiations, I know I'm probably too conservative because the numbers are incredible. Unfortunately, I still fear that Dutch Bro may be, let's say, too hot and could burn you. There is a price where I'd be telling you to buy this one hand over fist, but it's not 53. It's not 60 either, where I sense it's headed. Allow me to explain. First, as a business, I can't praise Dutch Bro enough. They give you delicious, high-quality coffee, very powerful coffee. And they serve it fast with a brilliant drive-through operation. They were way ahead of the curve on handling throughput, which meant Dutch Bro was perfectly positioned for the pandemic. More important, this is a stunning regional to national growth story, and we love those. See, Dutch Bro had 471 locations in 11 states at the end of June, and they still got a ton of room to expand around the country. I mean, look at this map. Now, of course, I went to this one, this one, 5 times to this one, many times to this one, and this one is killer. Maybe the best of all. They're huge in the Pacific Northwest, and the footprint's gradually spreading throughout the Southwest, although they're just getting started. If Oregon, my beloved Oregon, can support 153 locations, and there's like nobody in Oregon, you have to believe they can squeeze a lot more out of than 89 stores in California, 7 in Texas. They can put up 7,000, and that's before they even touch the rest of the country. Long-term management thinks they can put up 4,000 stores nationwide before this saturation. I think that's way too low. I think they can do many more than that. They've already identified 250 new sites. Again, they only had 471 stores at the end of June, so the growth pipeline is locked and loaded. Look at the part. Look at this. I remember when Dunkin' Donuts had to go east to west, and people just said, well, Jim, you shouldn't like that stock. But it went up and up and up as they put more and more stores. That's Dutch Bro going this way. It is going to be incredible. It's no surprise that people look at Dutch Bro and see the last big coffee chain that got its start in the Pacific Northwest and then took the world by storm. Yeah, no kidding. What am I really talking about here? I'm talking about Starbucks. Like Starbucks, they got an ethos, although it's very different from Starbucks. Dutch Bro is very, very focused on the customer experience, and so is Kevin Johnson at Starbucks. But listen to me. They don't just remember your name. Their system remembers your past orders. I'm telling you, it's surreal. They had my Annihilator drink down. After just a half-dozen visits, I felt like Dutch Bro was my home. At the same time, the drive-through concept, it's not that good. You're in a kiosk, it's not a great home. But I lived in my car for a while, so it wasn't so bad. It allows them to handle a ton of volume. The stores are typically less than 1,000 square feet, but they stick them on 25,000 square foot lots to handle all the car volume. That's allowed them to put up some magnificent numbers. Okay, get this. Last year, Dutch Bro store, which is just, again, the size of like this, okay? It's like this. I'm not kidding. It's like that, okay? Where'd those lines go? They had an average unit volume of $1.7 million. Can you imagine a space this big? Makes them among the best in the beverage business, maybe the best. It's an insanely high amount. Average check size, roughly $7.50. Coffee's not cheap. Excellent for beverage chain. Their new drive-through focus shops designed specifically to capture demand during peak hours have generated 40% more sales than the older models. On average, they expect new locations to generate 2-year cash-on-cash returns ranging from 35 to 75%. That's ludicrous. While more than half of their locations are currently franchises, management now focuses more on company-owned stores because the unit economics are just too attractive to pass up. Okay, that's Chipotle. And look, business is indeed booming. In the first 6 months of the year, Dutch Bro had 8.2% same-store sales growth, and that number was 9.6% for the company-owned stores. Just as important, they're putting up new stores like crazy. Remember, this is a regional and national growth story. I keep emphasizing that because it's the best kind. It means it's all about expansion. In the last 12 months, they added 70 locations. That's a 17% increase year over year. I think they're putting it up too slow. Put it all together, and Dutch Bro racked up 51% revenue growth in the first half, a major acceleration from the 33% compounded annual growth rate over the previous 3 years. Even better, the company's profitable, although in recent years, their earnings have taken a hit as employees cash in on their stock options. However, when you look at the earnings before interest, taxes, depreciation, and amortization, that's EBITDA for short, you can see a pretty clear positive trajectory. From $40 million in 2018, $70 million last year, just in the first half of 2021 came in at nearly $46 million. That's up 29% year over year. So it is killing me. I would love to recommend the Annihilator's parent, Dutch Bro. I think they got some bright future. I want you to have a piece of it. But I can't just do it. I can't just say, today is the day to buy Dutch Bro, which brings me to my one concern. Problem is, it's one of those situations where I would say, I don't know, it's just valuation. There isn't anything else wrong with this thing. Nothing. But it's an overwhelming concern. Dutch Bro currently has a market capitalization of roughly $8.7 billion. You could argue that Wall Street is valuing each store. Remember, the kiosk will give you that size again. Kiosk is $18.4 million. $18.4 million for this, okay? Do you think this is worth it if I had a little, a thing, right? Although it's a little reductive because people like this one for all the new stores they'll put up, that's how you can't just look at it like in a constant state. Still, when you run the same numbers for Starbucks, each store is valued at less than $4 million. No wonder the Starbucks people didn't like it when I suggested they buy Dutch Bro after I became a regular at their Ashland stores and discovered if I had an Annihilator on Thursday, I did not need to go to sleep till Saturday. What if we judge it based on EBITDA? Instead of just octane. There are a lot of bullish analysts here who expect the company to do $73 million in EBITDA this year, meaning the stock's trading at just 120 times that number. Not 120 times earnings, but 120 times earnings before all the bad stuff gets subtracted. Even if we use the estimates for the out years, it's selling for nearly 40 times the EBITDA consensus for 2024. By comparison, Starbucks trades at 20 times this year's EBITDA estimates. That's not the best compare because Starbucks is much further along in its life cycle. But even a smaller, faster-growing chain like one that we like called Wingstop trades at 58 times EBITDA, less than half what people are willing to pay for the Dutch Bro. So let me tell you what I'm concerned about. My chief concern is that rather than being the next Starbucks, Dutch Bro maybe could be the next Shake Shack. That's another chain that I love to go to. Shake Shack came public at 21, nearly 7 years ago. Then the stock jumped to just under 46 at the end of its first day. Within a few months, it had reached the 90s. But a year later, Shake Shack had sunk to the 30s because the stock was simply too hot. If you bought Shake Shack down there, you've done very well for yourself, but you had to wait for the right moment. And by the way, Shake Shack did not have the kind of growth ahead, even, it's great growth, but nothing like the Bro. Bottom line, when a great company like Dutch Bro has a super hyped IPO and the stock explodes higher because people like the product so much, you got to keep the bat on the shoulder. I think you can start buying this one if it drops down to 40 or some sort of crazy sell-off. But I wouldn't be surprised if it gets there when the lockup on insider selling expires next year. But this is one of the rare times that I have to tell you, I want you in this stock. I just don't want you in this stock at this price. Let's go to Tyler in Massachusetts, please. Tyler.
Hey, Jim. Big booyah from you.
Booyah back.
All right, I just had a quick question about Boston Beer Company. Just want to get your take on it after being 60% down. Is it a buy or a sell?
No, I mean, look, I had to deal with Constellation the other day, and Constellation had a bad miss on this hard seltzer. Can you imagine if, like, most of your business is hard seltzer? That's Sam. That's Boston Beer. I said stay away from it for about 400 points, and I'm reiterating, I don't want you in that stock. I'd rather have you in the Dutch Bro. And when a beloved brand like Dutch Bro comes public with a bang and stock keeps soaring, I am saying that as great as these are, they're a little calorie prone, I have to tell you. You got to exercise some restraint. And I love this stuff. I don't want you to get burned by one of the greatest coffee chain ideas that is being executed right now in this country. I think you can start buying the stock of Dutch Bro under 40. Much more mad money ahead, but keep it in mind, I have to exercise caution. And if you sneak a few shares in right now, I get it. We're going to have Uber Freight on later. That amid a trucker shortage, how is this important division of Uber working to ease the tension? A division that you've never heard of. I'm talking to the co-founder and head of that division. Then there's a lot to be said about today's amazing quarter for Bank of America, but there's one that hasn't been said, and I'm going to tell you about it. The Annihilator. Oh man, after the Eagles win, I could have 5 Annihilators, and then I'd see you on Wednesday. All right, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.